Okay, folks, welcome back. This is the midweek review for the ICT Mentorship, August 5th, 2020. All right, so we have the dollar index on the left-hand side, and we're working with 15-minute time frames today. So we had a nice sell-off in here, a little bit of an imbalance that we got overzealous with, trading back to the rejection block, and then sent it lower, traded back into mitigation. Right there. Displacement again. Almost an immediate rebalance on this candle here after the large down close candle. And then sweeping below the fair value gap discount level that we've been referring to on the dollar index. Almost made it down to the 92.55 level again, and then moved back up into fair value here. We have a smaller one in here as well, but I'd be interested to see if we have a continuation on the downside from here. If it does go up a little bit more, I'm watching here. I don't think it needs to go back up into this level. Okay, it's better if it keeps this open, unfilled, and then roll over going lower, or we're expecting to go sideways. Okay, so we're not trying to predict reversals. All right, and the euro, you can see we had a optimal trade entry in the London Open. Beautiful fair value gap bullish order block. Low of the day at 4:15 a.m. handsomely now. Expansion of the upside, fair value gap, discount end of the range. I'll scrunch this up so you can see. Here's the premium end of that range we've been referring to. So I'm going to count you go back and watch the previous video or videos, and you'll see that these levels are obviously taught and shown what they are. And another level of displacement, fair value gap here with order block. We traded back down into that recently, at the time of this recording rather. And I had a simulated entry here. I was teaching with the breaker. Okay, so we have a low here and a lower low. The highest up close candle in that swing high is your bullish breaker. So we have to look at how to trade that. And I screen captured a little exercise this morning. And once it breaks above that, when it trades back down into it, that is the optimal level for trading the breaker. Okay, you have to have an underlying directional bias. We're looking for higher prices, and there is a fair value gap as I instructed on yesterday's video to look at. Go back and watch that because it doesn't appear in this chart here. So I'm a little clumsy with this trading view still. So I create the templates, obviously. You can see here. That usually when I click on that, it saves it or updates it, and for whatever reason I forgot to do it when I made my annotations on the euro-dollar chart. So I'm just discovering it now that it doesn't appear here because I was working with the cable chart prior to this one. So a little unorganized, but you guys can obviously go back and look at yesterday's video and you'll see let me see if I can pull it up real quick. It shouldn't be in the chart, but yeah, we were looking for this fair value gap right in here to fill. Price was down in here. We could see it reach up into here, and we saw that happen, but we hadn't seen it until this candle right here. And then we have the rejection block here, extended out in time there. Actually, I think it just falls 1 pip short of that. But the 4 hour, if you look at the 4 hour rejection block in this swing, it works perfectly. It's just a beautiful delivery of that. But nonetheless, that's the fair value gap. And we drop down into a 15-minute time frame. And I want to go into this area right here on a 5-minute chart and show you the framework for that. And then I'll show you the actual setup. So here it is. We have a swing low here and the lower swing low trading into a fair value gap. So this BISI is filled with sell side liquidity taken. Breaker. Okay, this is a bullish breaker. So I'll highlight it like this. Okay. So price first initially on this candle right here, this candle, that one. When it breaks above this up close candle, you now have triggered a potential bullish breaker. So it has to trade back into it. It does so immediately. Okay, and you actually watch me trade the entry in a moment. I'll show it to you. Also, just real quick, the microphone, while I was doing the voiceover for that segment, because I was recording it as I was making breakfast for my family. Multitasking ICT. So the audio is actually dubbed in over, but you can clearly see what I'm doing relative to the entry and such. But the breaker is what I'm trading off of, and it has to first break above that candle. And when it comes back down into it, we're expecting price to trade higher, or I'm expecting it to trade higher. Let's put it that way. You can see I had a best case scenario exit at 119.10, which is 10 pips above the big figure 119, and it was having none of that today. You can see the high comes in at 119.04 and 9 pipettes. So just shy and short of the best case exit that I was outlining for that exercise. What I'll show you right now. All right, so we're looking at the euro dollar. This is a New York session trade. I'm going to illustrate a breaker. This is a bullish breaker, and you first have to identify the breaker candle, and that is shown right there. And it has to trade above it first. That's the initial filter. And there's other criteria here I'll show you in a second that's leading to it, or the narrative behind it. You can already see that we've already traded down into our fair value gap. And we broke the breaker. So now we're trading back inside of the body of the bullish candle that makes the breaker. We're inside the New York kill zone, and I'm going to be looking for a run above that fair value gap that's shaded in gray. I gave you insights about yesterday in our daily upload. And there's the fair value gap. We've already seen it trade down into that. And I'm going to make it a very, very small trade so it's of no significance. The money's not the issue, but it's going to be a minimum 1-to-1 before first scaling. So I'm going to be risking 15, so I'll take something off at 15. Okay, the market entry is there. And watch the candle. You can see is literally no drawdown. Now this is obviously on the paper trading application through TradingView, so this is not a live trade, it's just for simulation purposes. So it should expand up away from that bullish breaker, and my best case scenario exit would be 119.10, which would be 10 pips above the big figure 119, but I won't be doing that for this trade. You'll actually see me close the entire thing. Market expands up. We're in the top end of that fair value gap, so at the premium level of the fair value gap, and then we're expanding above it. So I want to be exiting above that because we are in a premium. It could have a retracement or a reversal. So as it trades up, we want to try to capture 20 pips or 15 minimum. Rolling right along now. And there you go. So obviously you can see it moved further, but that's enough for this example. All right, so you can see in here, this particular candle, it was the entry, and then literally no drawdown whatsoever. Now, obviously, you know, I'm not sitting here trying to beat my own drum and say, hey, look how great I am. But I want you to see what it looks like when you're trading and how to do exercises. Doing 20 pips here. Now, I could have done very easily another trade where I've taken this one in here. That was an exercise, and it rallied up. And right in here also, there's a small little fair value gap, again, that didn't close, where we come down into it again there, and then it runs the relative equal highs. So in this fractal, okay, we have multiple trades. And if you drop down to a 1 minute chart, there's actually a couple more in here, but I'll leave that for your own personal study. But I just wanted to give you a little bit more value and show you what it looks like when you practice and how it would be utilizing a bullish breaker. The fair value gap in here, we already had multiple times trading down into that, and there's no necessity for it to reach down in there because, again, we have the context of the breaker here. So if it trades higher, which is what I was waiting for, and you can see that in the exercise I just showed you, this candle broke above it and went back and down into it. Now, normally, and you probably would have expected something like this too, because if you read a lot of books like I did back in the 90s, this looks like the classic fake out. Okay, so we have this equal highs or double top, and the market runs above that and then starts to come back down. So they're going to look at this and say, oh, it's making one of those pin bars. No, I'm looking at that as an entry. So I'm taking the whole entire retail perspective on candlestick formations, trying to pick tops. Never, 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 never try to do that. Okay, it's easier for you to get in sync with the marketplace and follow the institutional order flow. If you don't do that, you're going to get caught on the wrong side of the marketplace, and it's very, very frustrating. But beautiful delivery, sends it up into the 119 big figure, just a little bit above it, almost to the 119.10. But I actually discovered today while doing that exercise, not that I had a whole lot on, because I used the lowest thing I could think of in terms of leverage, because I don't want you focusing on the money. I'm focusing on how to see the setups and share them as it happens, so that way you can see the framework. This trade from here to there, getting at 20 pips, that's all I'm saying to you. Well, 25 pips, really, say it like that, Michael, because I've been consistently saying if you just make 25 pips net per week and you net 2% on that trade, you literally can have a legacy change in your whole entire family tree. Like, you can transform everything about your personal life, your finances, and you don't have to do a lot. Obviously, 25 pips is like this, that almost delivered the entire thing. If you would have held on to it just to get to the 119 big figure, forget trying to get the 119.10 best case scenario, just 119 big figure, or just below 119 big figure. You know, that's the trade. That's it. You're done. You would be done for the week. And that's what I'm trying to build in all of you, okay, as an expectation. Because if you use that as your foundation and you get really good at it, you're going to see how many times these 20, 25 pip trades per week form and how often they form. And it's just like Candyland. You just go in there and just take what you want. But it's going to require some skill and practice, but that's the fun part. See, you're looking at it as, oh, it's work, it's a lot of things I have to take care of to figure that out. But it's not anything that any of you can't do. It's very easy to follow the process of practicing, and the amount of time it's going to take for you to find them and see them and be proficient with them, it's going to be uniquely different across the whole, I guess, community, I guess, is the best way of saying it. Like, all of you are going to have a faster or slower period of, growing into the consistency side of it. You're all going to have it at a different time. And just because you have exposure to all the lessons the same way doesn't mean that everyone has the same exact results on the same timeline. All of you are going to arrive at different times, but it's going to be exactly when you're supposed to be there. And I don't want to sound like high and lofty and Mr. Motivational. It's just, that's the facts. Okay, everyone's going to arrive in their own good time, and nothing I'm going to be able to do to supercharge that except for just tell you keep practicing and doing these things. So I showed you an example of what it looks like, used all the the familiar things you learn in the core content, and that's it. It's just that simple. Very, very precise. I mean, literally zero drawdown. I mean, it's like boom, it's there, and the trade takes off. And that's using a 5-minute chart. If I show you with a 1-minute chart, and we're going to zoom in this little area right in here, right there, okay, and you're going to see on a 1-minute chart, it's freaking obvious. It's so obvious. All right, so here's that 1-minute chart. So here's a equal highs, and price creates this initial surge, and it does what? Right here, this candle's high. Let me get out of the way here. This candle's high, okay, and this candle's low. There's your fair value gap. So it would look like this. Okay, right there, boom, as it hits that right there, that's when you'd be going in long. Okay, I was anticipating that without having to see it on a 1 minute chart. I was watching it as it came back into the breaker. I knew that this is going to exist. Whenever you have a quick sudden pop like that, there's always going to be a fair value gap in here. Never chase it when it's up here. Give it a chance to come back. And if it doesn't come back, who cares? Get the next trade. But beautiful, beautiful precision again. And also, we have a low, a high, and a lower low. Last up close candle right in here. Draw that out in time. You want to be a buyer when it trades into that. Bam. Hello. Takes off. And ridiculous reward to risk being so high versus the low risk that would be required. Now, I know you look at this right here and you're probably thinking, well, why wouldn't you expect it to run below those equal lows there? Because we've already stabbed into this fair value gap and the fair value gap on the 5 minute chart that I showed. And we had 1, 2, and we're inside of the breaker. Okay, so there's an hierarchy to the PD arrays. That part I haven't taught yet. That's why I'm trying to tell all of you, when you run into people that have not really entered this mentorship and they find things on the internet, people share parts of the core content, or maybe they even have all the core content general lessons. They still don't know what they're doing with it. Okay, I have yet to tie all that stuff together. You have to understand that there are things that you're going to learn over time because I'm slowly releasing it. Okay, that's what I've been doing this long, because you need to be spending time doing the things I told you to practice and research. And if you don't do that, and you're just waiting for the next video to drop or the next, commentary or whatever, you may be increasing in your learning, but your understanding is not growing. Let me say that again. Just because you're listening to me and I'm showing you concepts conceptually, or I'm giving you commentary, you're learning and you're increasing in your learning, but your understanding is not, because you have to gain the understanding by going in and practicing yourself, experiencing the moments where you go in and you engage. You stick to it. You say, okay, this is what I think is going to happen. I'm going to practice it, and then boom, you enter it. And use the lowest possible leverage, because you don't want to train yourself to watch that money. You don't want to get worked up into a frenzy when it's paper profits, and you don't want to get into a state of panic. Like, what if I'm wrong? Look at this. If I would have had a real trade on this, would have been $3,000, because everyone's trade went over leveraged trades and they put them on social media. But I want you to train yourself to look at the price delivery and the reactions and the precision that you're learning in here. If you don't do that, you're really not going to appreciate what you're being exposed to. And the real mentorship is you practicing the things I've instructed you to do. That's where the real understanding comes. It's not by watching the videos. It's not by waiting for the new secret recipe to something. If I stopped right now and never put another lesson in the mentorship, you all have the ability to be multi-millionaires under 5 years, no matter what you start with. I'm going to say that again. If I stopped right now and never gave you another lesson with the mentorship, not anything, just stopped, what you already have in your hands right now can make you a multi-millionaire, not demo baller, multi-millionaire. Real money, real folks, in 5 years or less. Now, a lot of you don't want the 5-year plan. You want the 3-month plan, and that don't work. No one's turning out like that. No one puts people into that position like that. It doesn't happen. If you put in the work, you're going to get here. But if you don't do these types of things and practice, and at least try to do one of them, one per day. And New York is a real easy one. Even if you have a desk jockey job, you have a smartphone. I'm not encouraging you to steal from the boss's time, okay? But listen, people take smoke breaks all the time, and I'm not saying you should take a smoke break. You shouldn't be smoking. But if you know, around 8:30 or so, there's typically a setup that forms because of the news embargo lifting when the economic calendar spits out data based on something occurring, or when there isn't any data coming out. Sometimes when there's no reports expected to come out, 8:30 still surprises. Now, if you didn't write that down in your notebook, you're not paying attention. I'm not going to repeat it. So if you go in and you start expecting these little tiny setups that form every single day at 8:30 or very close to it, like between 8:20 and 8:40, anywhere in there, just do a research project and start studying all the currency pairs, and you're going to see there's your bread and butter staring you in your face every single day. 15 to 25 pips every day, like clockwork, Monday through Friday. It is there always. Don't take my word for it. Go back and study it. Now, I don't know about you, but my calendar says there's 5 business days to every week. Now, I don't count Sunday because we don't know what to expect on Sunday. It's like a crapshoot. You don't know. But Monday's trading to Friday's trading, that is your week. So you have 5 potential trading days. How many New York opens are there in a week? Monday through Friday. 1 per day, right? Pretty obvious. So that means you have 5 setups that are waiting for you every single business week. Let that sink in for a moment. So if you can capture 10 pips, 5 pips, as I mentioned on Twitter before I deleted my account, and no, I have not skipped town. I'm not running away with everybody's money. I'm just focusing all my attention on all of you. And the free time that I have outside of that, then I'll just work with the YouTube channel. But if you haven't gone to Twitter yet and you try to put my Twitter handle in, it says that that account doesn't exist because I deactivate it. Every 15 days or so, I'm going to reactivate it so that way no one can take that handle, because believe me, someone is waiting for me to wait 30 days and they're going to try to get that handle. I underscore am underscore ICT. I'm not going to make it available to someone like that, but I'm off of social media. And I'm going to be honest with you, today I got a lot of things done. I was a lot more focused, and I outlined a lot of lessons that I want to get through in the remaining portions of this year, but I'm getting off track already. So let's bring it back. Just know that I'm not on Instagram anymore. I'm not on Twitter. If you see anybody pretending to be me, then obviously let everybody know that that's not me, because I'm not going to be on those mediums to see what they're doing. So anyway, you have Monday through Friday. Every day there's going to be an 8:20 to 8:40 a.m. potential setup. That means you have a stop run or a fair value gap. One of the two. Okay? If you simply start studying and looking at it, and if you have an understanding of what it's likely to do in directional bias, like I mentioned yesterday with the euro, it's likely to pop up into that fair value gap, and we got it, and it actually over-delivered and went a little bit more than that, which is fine, but we don't require that. But if it offers 10, 15, 20, 25 pips or even more, that's awesome. But you only need, 5 per day? Even if you take your position on and you say, okay, I'm going to risk 1% per trade, and you take off one half the position off at 5 pips. As soon as you get into profit 5 pips, you just scale it off. What that's going to teach you, and I'm not saying that's your career, because you already know what you're saying to yourself right now. You're pulling your calculator out and saying, okay, he said to risk 1%, and then he's going to take 5 pips off, and half the position comes off there. And I do that Monday through Friday, and you're going to look at that number, and it's going to be like, what? I'm not going to get rich like that. It's not meant for you to get rich like that. It's get you training your mind to see things repeating over and over and over again. So you go to work, okay, and none of you are disgusted to the degree that you should be about how little you get paid. You are planning your night. I got to go to bed early. I can't wait and watch this movie with my spouse. I can't stay up late and watch these video games with my sons or daughters, okay? I can't do the things like we normally could because of all the COVID stuff. So the nightlife stuff is pretty screwed up right now. But you're all disciplined in the regard that you have to go to bed so you can get up on time and not be overly tired, so that you can put in your time with the boss. So you need to sit down and say, okay, I'm starting with a foundation that requires a process. The process is you go to bed at a suitable time and you get up, you prepare yourself to drive safely to work. Are you in danger every single day going to work? Absolutely. That's risk. Your stop loss is your insurance company, because if you get in an accident, God forbid, they're coming in and doing their job. They're picking up the tab, or not all of it, but most of it, and you're still experiencing some loss of mobility, probably from an injury. You missed time at work, and your properties are damaged. So everything has incurred risk, but your perception about trading right now, you have all this, I don't want to be wrong, I want to be right, I only want to make money, I don't want to lose, I want to trade without a stop loss because I don't want to experience being stopped out. You're making it impossible. You're making it impossible. You are, not me. You are doing that. And that's what I'm trying to tell you, that you have to go in and practice with a frame of mind that says, okay, I'm not worried about the money. I want to find these setups over and over and over again. These reoccurring IPTA signatures that happen every single day. I just gave you one today. Between 8:20 a.m. and 8:40 a.m. every single day, there's a setup that will yield 10, 15, 20, 25 pips. Don't take my word for it. I don't want you to say, oh, that's pretty cool. No, go in your charts and look for it, and you'll see it. The only caveat is that you have to have a bias. What side of the marketplace you work on. And I know there's members that are just now rolling into month 3, and you're like, I need to know what the monthly bias is. I haven't figured it out yet. ICT, I'm in the mentorship, I'm in month 4, and I still don't know how to trade. That's normal. How can you expect to know everything, or even know what you should be doing, if you haven't even completed the core content and got to the charter level? So it's a little annoying that the folks don't listen, especially the month 1 content, because I explained this expectation that you should have. And it should have very low expectations. Not in what you're going to learn, because you're going to learn some things that's going to blow your socks off here. But the point is, your expectations on yourself should be very, very low. Because if your expectations are low, number one, you've, without saying so, given yourself permission to grow exponentially, and not constantly on a day-by-day basis say, oh, I didn't see this coming, I'm not learning anything with this. This ICT mentorship is full of crap. Oh, he's only doing it, but he's not really teaching it. Yes, I am. Like, you literally could have just did month 1 and never did anything more, and you could be a profitable trader. Like, that's the reason why I did month 1 the way I did. It is putting you on the ground running, looking for setups. Everything that you start with month 1 is always going to be referred back to as you go deeper in the mentorship. I give you more details. I flesh out more of the IPTA signatures, more of the algorithmic theory that's no one's learned yet. All those things come together, and then a light bulb moment happens. It's like, boom. Oh, there it is. There it is. See, right now, a lot of you in here are waiting for that aha moment. And it's going to come wherever you're feeling that you're struggling the most. And believe me, if you could see all the emails that come into me, there isn't a whole lot of overlap except for the daily bias. Okay? Tell me the daily bias and I figured it out. I got the keys to the kingdom then. No, because you'll screw it up in other ways. You'll over leverage. You'll enter too soon or enter too late, and it'll mess with you and you won't be able to hold a trade. So believe me, that part isn't the holy grail. That's just one simple component. And you don't even need the daily bias. Once you understand a couple more things later in the mentorship, you can trade without the bias. You don't need it. Okay? You do need to know what the PD array matrix is and where the liquidity pools are, because if you know where they are, then you don't even need to have a daily bias. But again, that's assuming you have a whole lot of things behind you and are charter level, and those charter levels are still getting to that point. So anyway, that's an example of using the bullish breaker, and then also on a micro level where it trades down to it here, and then we have this displacement. So even if you took an entry here and got out right up here and said, okay, I'm calling a day at the institutional 80 level. So 118.80, done and dusted. Your day's over. Well, good grief. That's 25 pips. Like, you nailed it. You're done. That's your whole entire week. Your entire week. How many minutes is that? Well, if you enter on this candle here, it's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Okay, I don't know about you, but a 12-minute work week. I should write a book. The 12-minute work. No, it's rounded up. It's got to be at least 15 minutes, because otherwise nobody will believe it, right? 15-minute work week. Good grief. Like, that's, you ever read the book 4-Hour Work Week? That's actually a pretty good book. But nonetheless, you only need one of these setups per week, and it will replace your job. Over time, getting back to my example, you thought I forgot, didn't you? When I said if you take a trade that's 1% risk, and you train yourself to take something off at 5 pips, and half the position comes off, that means one half of 1% rather comes off the position. So you're not paying yourself a lot by doing so. It's only 5 pips and 0.5% leverage. So it's not that you're making a lot of money. It's teaching you how to scale off and give yourself that lower risk, and you rewarded yourself. And it's a process that fleshes out from very small increments, like 5 pips and 10 pips and 15 pips and 20, 25, and so on. You train yourself. Okay. Now, one of the other questions I get a lot is how do I teach, or how can you grow into holding trades for the duration? The easiest thing for you to do is learn to take something off, because you cannot imagine how liberating it is to be able to take something out, and every other trade can reverse on you after that point. Like, every trade. Like, if you take something off and every trade comes back and stops you out at break even, you still come out, ahead. Your equity is going to grow. It doesn't grow exponentially, but it's growing. You're not a net loss trader. You're not a break-even trader, which is actually an astounding position to be in as a new trader. Like, if you're at break-even, man, you are exactly where you should be, because you're not losing money. You're maintaining and flatlining. You might give up a little bit of money, and then you get it back a little bit, make a little bit of profit, and then it comes right back to where you start. See, a lot of you think of that as failure. Oh, I can't make any money. Every time I make a little bit of money, it goes back to where I started. That's actually a good thing. See, I didn't start like that. I started with the roller coaster precipitous drop. Like, it was bad. Like, I was baptized in pain immediately. There was no sympathy for me. None. I got cracked real hard, and then I had to learn that if I don't do this stuff right, it's going to hurt me bad. You want to be able to grow from net loss to gradually break even. Then from break even, you're going to see explosive growth if you do the things I'm teaching you to practice with, and do them in a scaled manner. And what do I mean by that? When you practice, you don't want to be counting money. Okay, don't think, okay, I've made this much money in my demo account. This is how much money I made in my demo trade. That's stupid, because you have no idea why you took the trade. Okay, let's be frank with one another. Okay, when you're practicing with a demo and you're learning how to do this stuff here, whether it's my content or someone else's stuff, when you're practicing with a demo, you really don't know what you're doing. So when you look at a win that's on paper and it's paper profits, you're taking that as, oh, I'm skillful. I'm smarter than I thought I was, when you have really no idea what you did. It just happened, and then, okay, great. And you roll with that sugar high, and you're really not supposed to be doing that. A demo account, especially in the beginning, should be utilized in the sense that you're operating with price action, but not looking at money. Because a demo, listen, you can't buy dinner with demo dollars. You can't do it. So to build your mindset around that monopoly money, and that somehow translates to significance or aptitude as a trader, that's the wrong, because you're poisoning your mind and you're poisoning your expectations. See, you don't have any risk whatsoever except for your pride if you're wrong in a demo. You have zero at risk. So when you train yourself to worry about being profitable in a demo with outrageous leverage, okay, and putting on the trade and not using a stop loss and just waiting to see what happens, and then when it works out in your favor, attributing that as skill, you're programming your subconscious to think that this is the right way to trade, when it's really not. Because what you've really done is you've taught yourself, or training yourself, to trade without a stop loss, trade without any idea what you're doing, and whatever happens, it didn't hurt if it's wrong. And if it's right, I'm right, and that means I'm skillful. You really think about it for a moment, because all of us have done that. When you first started messing around with a demo account, every single person that has ever opened up a Forex demo account has done what I just said. But the problem is, most people, especially everybody on Instagram, they keep doing the same thing over and over again, and then they're going to share their wins. And if it doesn't win, they reset their account with another demo account and hurry up and put another trade on, over leveraged. And that way they can prove online, because then they have people saying, wow, that's a good trade. And that little emotional band-aid gets put on top of the boo-boo that really existed by them not knowing what they're doing. So what they're doing is, and what most of you are doing and probably don't realize until now, is you are stringing yourself along with all of these internal lies. They're lies. You're feeding yourself toxic thinking. And you don't want to do that with a demo. You don't want to be doing that in the beginning, especially anyone that's in core content. That means if you're still making payments in the mentorship, you should not be trading with any leverage whatsoever. Whatever the smallest leverage you can use for your demo, that's the one you should be using, because it'll teach you to focus on the most important thing, which is price. Because if you can find these setups like this, okay, every single day, you don't need a job. You don't need a boss. You don't even need a lot of money. Because if you can do this every single day and parlay that up over and over and over again, doesn't matter what you start with, $25, $100, $1,000, $5,000. There's no perfect amount. Like, that's what you don't understand. Like, the compounding effects of being consistent and knowing exactly what you're doing, and that once you get it, don't go back in for that day. Be done. Well, none of you have that conviction right now. None of you have that discipline, because you want to trade like you've seen me do on my YouTube channel. Up, down, up, down, up, down. And that's not realistic. Like, I couldn't do that in the 90s. I couldn't do that at all. I could not do that until around 2006. That's how long it took me to get to be able to do that kind of stuff. Now think about that. I started in 1992, formally trying to learn. I was introduced to trading when I was 16, and it was going in one year out the other. But at 1992, November 5th, I began, and I was really making an attempt to try to learn. But it wasn't until 2006 that I could work inside of the daily range, both directions, up, down, multiple trades, scalping both sides, and do high frequency trading. You're not ready for that, okay? And you're not ready for that, okay? But you don't need that. You just need one setup, get in there, capture it, be done for the day, go back in the next day and see if there's something else to practice with. And when you look at your entire month, okay, when you look at the entire month behind you and see how often you were wrong, how often you were right, and how many pips you bagged, it'll give you a level of confidence that I can't adequately describe. Like, I can't articulate it. Nothing. I could sit here and cheerlead and pump you up and say all the good things I can imagine, and all the adjectives and enhancers, okay, sentence enhancers, the bad words that I've said in the past in YouTube videos. I can make it, as epic as I possibly can verbally, but it will not come close to the feeling of empowerment that you will possess. But here's the thing. Here's the rub. It doesn't happen by watching me. Because if that's the case, the millions of people have watched me on my YouTube channel. What's up with that? Why aren't they stepping forward? Why aren't they ICT millionaires? Oh yeah, ICT made me a millionaire because I watched this video. Never happens like that. They hear me talk, and like I'm talking now in this video, you talk too much, ICT. No, I'm telling you what you should be doing. I'm telling you how you should think. If you listen to me and follow my instructions, however long the videos are, however wordy, okay? I'm not wasting my time talking, and it's not that I like hearing myself talk. I'm telling you that these are the things you have to do. And no one has really shown a willingness to do all those things, because it's a distraction when they think they figured it out and they jump ahead and they start doing live trading way before they should. It should be absolutely boring to you when you look at price action with no money and a demo. It should be boring because you can see what's unfolding and you can get in, put the trade on. There's no emotion, and there's no worrying about the money. And if you're wrong, who cares? Because you know it's going to happen again tomorrow. If it happens in a series of losing trades, 3, 4, 5 in a row, it doesn't negate or change this model. It's always going to exist, and you're going to have losses. And I want you to look at your month and say, okay, if I would have been trading for, say, 36 months, and I was trading with, say, $30 to $40 per pip, over time, you're not going to start there, obviously, but over time, building it up, I don't know how much each of you make at your job, how much you earn in a day's wage, how much you earn on a weekly wage or a monthly wage, but I am telling you that you absolutely can replace your job easily. Like so easy, it's ridiculous. But the only thing preventing that from happening is you're not going in and practicing and engaging. That's the work. That's the things that you are supposed to, you are expected to do that. I've already given you thousands of hours, but you have to go in and put thousands of hours into practicing. And once you get it, I can't take it from you. The market can't take it from you. Your boss can't take it from you. Your spouse that may not believe in you right now won't be able to take it from you. Your friends that think you're wasting your time, they're not going to be able to take it from you. And your outlook on, like, you can feed yourself and your family no matter what. Think about that. Your job's not guaranteed. Look around. 40 million people, if you believe the statistics, found out real fast that job ain't security. Now, I'm not trying to make light of all that. I'm not saying that you're not going to have hardships because, as I mentioned in a couple of videos back, that I think we're going to enter into at least a few months where trading is going to probably be impossible because the volatility and that level of volatility that may present itself may shut the markets down for a little while. They may not say, okay, but we're not going to trade equities because the markets are doing this or that. Okay, I'm not sure what Forex is doing, in terms of shutting down, because they don't generally shut down, but they can become illiquid. That means running up hundreds of pips and down hundreds of pips within an hour. Like, that's volatility. I can't trade in that. I wouldn't even attempt to do that, anything like that. If I see a market doing something like that, I am not touching it. And we could end up in that. Okay, so just know that barring those events, you're learning how to feed yourself, feed your family, change the direction of your family and how they acquire income, and eventually could lead to wealth. Because if you could just replace your monthly note on your home or your rent, that's one of the largest expenses any one particular person is going to spend every single month, their entire life. That's the largest expenditure in money, which is your housing costs. And if you own a home, it's really expensive. So think like that modularly. Go into these exercises, okay, with a plan that I'm going to practice for the next 4 weeks. I'm going to do this, and this. And what is that? Look for a fair value gap or a stop run between 8:20 a.m. and 8:40 a.m. every single New York session. Look for 10, 15, 20, 25 pips to occur in that session. And do it every single day. Force yourself to practice. And that's the difference between forcing yourself to trade. See, right now, in practice, you have to force yourself to do that. Because it doesn't feel like what's the benefit? I'm not going to make anything, right? No. You're learning how to pedal that bicycle. You're learning how to shift your body weight to the left and to the right to keep that bicycle upright so you don't fall down. You're going to hit curbs and fall off, okay? Your foot's going to slip off the pedal and have a stop out, and you lose a little bit of what you thought you were going to make, okay, in the exercises. But over a period of time, how much time? It depends. All of you are going to do it in a different time frame. But you're going to learn how to do it efficiently. You're going to be able to ride that bicycle. Remember what it felt like when you were a child and you let go of the handlebars the first time? It was scary, wasn't it? I know it was scary for me. And in 3 seconds after I did it, I had no shirt on and it almost peeled the nipples off my chest because I hit the asphalt and slid. So that might be a little bit of a bad analogy to use here, but it's the real world. That's what happened with me in my trading. I went in there and got baptized with losses. I lost 50% of my equity. First trade, boom, overnight. But in demo, it doesn't hurt you there. You learn how to take that lump without saying, well, it took this much money from me. And I'm learning, what did I do wrong there? Or what did I observe? Okay? So practice that every single day between 8:20 and 8:40. It's just a small little 20-minute window. Just a 20-minute window, Monday through Friday. That's why I'm telling you, like, New York session is the absolute easiest trading time. Because it's always something there. Always. If it doesn't appear in a major, it's in a cross. If it's not in a cross, it's in a futures contract. If it's not in a futures contract, it's in an indice. If it's not an indice, it's in a metal. You just got to scan for it. And I'm not saying have a going. Now, I know you hear me say all the time, don't have a list of like 20-some markets to follow. But for practicing sake, you'll see that this forms every single day somewhere in one of these markets. Now, the critical jump in your understanding is going to come by when you look at when your Forex pair that you settle in on, how often it forms per week. And when it doesn't form, then a light bulb moment happens again. Because you're like, so what is it about the days that it does form? How's it differ from the days that it doesn't? Your clues are the economic calendar and the higher time frame charts. Oh, the plot thinkins. Go into your notes with that and study. Okay, I promise you, you will find something that will be very illuminating. Okay, and it'll be hard not to feel that tug of war in the corners of your mouth because you're going to be smiling. So anyway, let's roll on into cable. All right, so here's the British pound versus the US dollar. You can see we had a initial drop here in the Asian session, and then we had another drop lower running out sell side liquidity that formed on the Asian range low. At 4 a.m. we had a market trading down into a bullish fair value gap. In other words, a BISI, buy side imbalance, sell side inefficiency, and a sell side liquidity pool right there. Okay, and with a higher low there. So the signature is what? Potential low resistance liquidity run, fair value gap, off she goes. The market creates this would have looked like an optimal trade entry to someone that doesn't understand what we're looking for, but I find that interesting all the time. And then we had this candle here, trade all the way back down into this BISI, optimal trade entry here, and takes off during the New York session. If we look at a 5-minute chart on cable, so we have 2 o'clock in the morning, we have the low form here, market runs up, and then it comes slamming it down in here. Now, your question is going to be this: how do I know to be a buyer below this low here? How do I learn to do that? Well, you have to stick with a bias, number one. And I've already taught you how to trade this setup if you are unwilling to be a buyer below the lows. Because if I could take my mentorship and divide it into two classes, okay, and that being entering on internal range liquidity or entering in on external range liquidity, the bulk of you all predominantly like to trade the optimal trade entry or the fair value gap, okay, because it feels safe. You feel like you trust that low down here, and some of you would see this fair value gap there, and if it trades back down into that would be an optimal trade entry, and then you would suffer this loss here, and then it would completely blow your mind and you can't get back in the trade. Very little of you, okay, and I don't have a complete breakdown because not every one person has submitted some kind of an opinion, and I'm not asking you to do that because my inbox is already full with my emails. But if we were to like poll everyone, what do you, maybe I should do that. Maybe I should create a poll on the forum, and that way y'all can see what the I guess the the skew is between how many like to trade internal range liquidity for your entries and external range for liquidity. Majority of you don't like to buy below old lows because you don't know how far they're going to go down. That's the number one consensus with that, and why it's not the case. But you can wait to see this form. You can anticipate it, but say, I'm not willing to buy it down here. I want to see, let the market prove to me that it's going to do what I expect it to do, which is trade below the low here, and then trade back above the low, which it does here. And then the market creates a fair value gap right there. So we have this candle's high right there, this candle's low, and there's your fair value gap. The price trades down into it, takes off. Fills in the BISI again here, runs again. Fair value gap, breaker, low, high, lower low, last up close candle right in here, extending out in time. There you go. Bullish breaker, optimal trade entry. If you use a 1 minute chart, I'll let you look it down in your own chart. Trades down to the rejection block right there with optimal trade entry and bullish breaker. Wow, that's 3 things on a 5 minute chart. Yes. And what time of day is it? New York Open. Takes off, trades back down in, mitigation, sell side liquidity, fair value gap, pops up above the mid figure 130, 150. Beautiful. Any one of those setups would frame a 10, 15, 20, 25 pip trade. Do your exercises in there, engage it, work with it. Don't be afraid of the outcome. Be interested in the outcome. And here's what you need to be studying. How do you feel about what took place? Do you feel anxious? Do you feel like you knew what you were expected to see, and when it delivered, do you feel empowered because of that? Do you feel that you waited too long before entering? Do you feel like you entered in too quickly? And you want to be putting that in your journal, your study journal. When you do these exercises, you have to be recording that and be honest. Now, it doesn't mean I was stupid, I waited too long, or I was stupid and I messed up and I'm never going to get this. I don't know why I'm wasting my time. You don't want to do that. That's toxic. You don't want to put any of those things in your study journal. You want it to be monotone. Now, you can be elated when you discover something, but when the results come and they're positive, you do not show elation there. Now, you can say, I was pleased, or I'm appreciative, or I'm thankful that I'm showing progress, but never, never, never sugarcoat your good stuff. The things you've done right, don't get so sickeningly sweet with it, because what you're doing is you're training yourself to look for that all the time as a result. Okay? It's steak and potatoes here, folks. Okay? It's how you do it. It's not the apple pie. Okay? It's literally just getting what you need to eat. And that means feeding your brain, feeding your mind, feeding your expectation, and not building this expectation with a sugar tooth that it's always a feel-good moment. Because if you set yourself up with that, it's just going to be a long, arduous task to get to where you want to be at. And I'm not going to be able to fix it for you. You're creating all of those elongations in your learning curve. You're making it longer than it has to be when you introduce and invite emotional responses or framing the results on an emotional basis. You don't want to do that. So your study journal is monotone. It's sticking to the facts, and in how you watch yourself move away from. And try not to do this. Try not to think, like, 5 entries ago in my study journal, I made a comment about how not able to see this at this moment. And now, today, I'm going to say, I was able to see this, because it's almost like you're kind of like scripting something that you think should appear in your study journal. Let it be organic. If it doesn't come out naturally, if it doesn't simply flow from your experience doing it, then it's fake. And you don't want to put anything fake in your study journal. No one's looking at this thing but you. So you want to be able to pour yourself into it, and with absolute honesty. And if you don't do that, you're going to make this a whole lot longer than it has to be, and you're really robbing yourself of the development advantages from going back and looking at the milestones where you were looking at certain things and you thought this was going to occur in price action and the result was something entirely different. What was your thought process while in the trade exercise? What was your thought process after the trade? And are you excited about the next setup, or are you just indifferent that I'm going to wait for the next setup, and then there it is? And then when you close out your month, you should be putting a study journal entry for that month and say, okay, this is what my week 1, week 2, week 3, week 4 results were. Overall, on the weekends, you should be giving yourself a overview of what you felt psychologically and emotionally throughout the week. Were you sick? Were you at optimal health levels? Were you under any kind of stress? All those things are important to record in your journal on a week-by-week basis. And if you can, make a short little annotations each day, because everybody has a good day and a bad day. Okay, everyone has good days, bad days. It's just, we're all human. But you really want to encapsulate that week on the weekend when you do your recap. Like, what did you do over the entire week? Were you on an emotional high? Were you in an emotional rut where you were maybe having a problem with your spouse? Maybe your children are going through some stressful event. Maybe someone's sick. All those things. And why is all that important? Because some of you are saying, I ain't got time to be doing all that. Listen, you have no idea how much of an impact normal everyday things occur in every one of our lives, that they have a detrimental effect on our development, good or bad. Because if we're really doing well somewhere else in our personal life, we can come in thinking that, we can't do anything wrong. And it gives you a false sense of security, and you overtrade, you use more leverage than you're supposed to, or you just shortcutting everything, thinking that you're better than you really are because you just hit 4 grand slams in your softball tournament. Okay, I've done similar things, folks. I'm telling you from personal experience. These are things that I made mistakes doing, and that way, when you look at your results, okay, and you look at your week-by-week results and overview, and then you encapsulate your entire month, what your feelings were about the month, okay? Did you follow everything you're supposed to do? Did you cut corners anywhere? Were you lazy in any one particular day? Record those things, because then when you look at a poor month, you're going to find that these reoccurring things, like you're having trouble with your marriage, you're having trouble with your children, maybe you're taking care of someone in your family, your mother, your father, or a sibling that's ill. Maybe you're in a job that you're probably going to lose, and maybe you're in danger of being made redundant. All of those things are having a heavy impact on your perception of what you're seeing in the charts. And it's easy then to say, okay, you aren't really poor at trading, you're just poor at managing outside distractions. Okay, and then that helps you focus in on where your area of improvement needs to occur. Not so much in what you've learned from trading, but how you manage the outward, everyday to day stress and things that are always plaguing all of us. We all have problems. We all have families. I have a boss. My wife's my boss. So we all have to report to someone. And if your boss or your job is creating a toxic atmosphere for you, okay, you'll quickly know that that's what it is. And you may not have the luxury of quitting your job and changing right away. Some of you might have that luxury, and maybe it is the only thing that's standing in your way for you to be doing this for a full-time career, that being trading. And for others, it may be you need to learn more coping skills to, I guess, endure whatever this job puts on you. And maybe you'll come to the conclusion, and this is as real as it gets, folks, you may not be suited for trading while working that job, and you may have to defer trading until you find something else. And that's a reality. That you have to be willing to meet that reality and say, okay, this is what I have. I have a crossroads moment now. Do I continue on with this pursuit with my job and put trading on the back burner for a little while, or do I say, okay, I have to make a change, and I can have the income I'm making from this job somewhere else, and then I can pursue my passion, which is learning how to trade. So this is how you manage yourself. This is how you manage your expectations. This is how you use your study journal. You have to be able to use it as a tool. It's not a mechanism for you to lie to yourself and say you're better than you really are. It's not a place to put charts that you didn't really expect to see things unfold and put it in there and say, I made this much money. You can use the hindsight element of annotating your charts as you would have expected if it was a perfect world, and then you study them. But you have to know the difference. You have to know the difference. And over time, you're going to teach yourself, because of repetition and seeing it over and over again, the things that are building you up internally. The dialogue and annotations that you put on your charts are going to be programming your expectations and what you see in price. But the internal dialogue in your head that is only experienced by either studying it in hindsight or watching it live and engaging with that exercise or trade, those things are going to be much more meaningful to you if you are honest and record them in a capacity that encapsulates that moment. You want to try to, in the shortest little bit of wording as possible, you want to try to encapsulate every day and every exercise that you can, and encapsulate the entire week on the weekend. And then when the month closes out, you want to do the same thing for the entire month. Okay, and then you'll find that you're writing the best trading book for you that you'll ever read. Hopefully you found this insightful. I'll talk to you guys tomorrow. Until then, I wish good luck and good trading.